Hi, Larry Gaines, Power Cycle Trading. Well, in this video, I want to show you a couple of different trade setups and some of the things that have been working. We've had a nice retracement rally to the upside here over the last several days, and so one thing the market really hit Apple to the downside hard. But what we noticed was there's a big gap here. So if you look at Apple, and markets love to refill gaps. So if you look here at Apple, back here on the 2nd of January, it had this gap down the next day off that news item that they said they were going to revise their revenues down by about 9%. So it had this huge gap. Now, markets technically love to fill gaps. So yesterday, once we saw the market start to push back above this prior kind of areas of lows right here, we noticed that this gap was up at 154.23. So this was a great opportunity to set up a trade for a gap fill. And the overall broad markets were trending higher. So that's the perfect kind of environment. So we set up a trade, just a really tight call debit spread, just to retrace and fill this gap and see what happens after that. So here's the trade setup using options. So yesterday we set up a trade, yesterday being the 8th, we bought the 152.5, 155 call debit spread, just the January 11 series, so that's expiration this week, and paid 68 cents or 68 bucks. So that was the total maximum risk, so very low risk defined trade, and we were going to use probably half of that as a stop. So if it broke down to 30 cents, that'd be our stop. Now, we were looking for this gap fill right in here to 154, and we got it. So that was the trade setup. That was our target. Took that off and made about $60, $65 per contract. Now, you can see today it went out at 50, 51. But when your capital at risk is 68, you make 51 or 60 bucks. That's about 100% return. So really nice trade setup there. Very defined, low risk trade. Trying to keep the risk real low in this environment because it's been so volatile. And then one other trade setup that we're looking at right now, end of the day, was looking at coming into some major resistance and how do you trade that. One great way to do it is with bear call credit spreads. Let me show you. So here's SPY, the S&P ETF. So here's a weekly chart. So you can see right here, see this low back in October. That's where the market broke through this low and had that big breakdown. So it went from 260 quickly down to 234.33. All right, so markets tend to retrace back into kind of a snap back into the areas where they broke from. So we're very close to that right now. So today the market high was 259 basically, so we're very close into that 260, and then the 618 is the 262. So if you look at that, you could do a lot of different things with that, but one of the things I like to look at doing is bear call credit spread out of the money to take advantage of selling into resistance, but having yourself far enough out of the money that, if you're not exactly perfect on your timing, you still have a chance based on the theta decay. So the setup here today was looking to sell like about a 1 standard deviation out of the money. So you could sell the 2660 strike short, that's on SPX, and then buy the 2665. So bear call credit spread was trading right around here, 2585, so 2660. So let's take a look. So went out to the Jan 25 series right here, 16 days out. So, you keep it below 20 days or so, you get really good theta decay. And so looking for kind of a 1 standard deviation point out of the money sell, that would be around a 1820 delta. So set up here's the short sell right here was the 2660, so that was about an 18 delta. So selling the 2660 call, buy the 2665. So bear call credit spread, and that brought in $1, went out about $1 to 95 cents. So basically what you end up with is a bear call credit spread, and if the market, you can see where the market was trading right here. So this is gives you about a 80% probability of closing below that short strike. And the thing about it is, even if the market just goes sideways, so let's take a look. And let's say we come in next week on the 18th, put the calendar there, and the market has not moved, and we're still trading at 2585 or so right here. This trade will be up about 60 bucks. So that's just working off theta decay right here. So you can see here theta decay on this trade today is $4.54 a day. And as you get closer and closer to expiration, so like next week on the 18th, you can see how that theta decay has really crept up. So this is taking advantage of theta decay. Hope this helps. I'll talk to you on the next video up.